Welcome to the weekly update, where I'll go over the action in the market for the week of November 11th through the 15th, and we'll see how things look for the week of November 18th through the 22nd. Well, we saw a down week. Now, a week ago, it looked like everybody was happy. All of the charts were pretty much positive. It's like this market's never going to start coming down. Well, there's this thing called FOMO, the fear of missing out. And once there was relief after the election was over, it was like, okay, things aren't falling apart after all. Maybe we saw a win not only with the popular vote, but in the Electoral College, and there was a real relief over that. And it doesn't necessarily matter who won. It's just that there was a lot of concerns about the election and the fact that we didn't see riots in the streets and buildings burning on either side. And so the market really went up. Now, there is something to be said that the new administration is likely to be more pro-business. There's talk about the tax cuts being continued, regulations being done away with, and that could actually be more pro-business. And so the market really liked that, and we saw things really going up. But then you get this FOMO, the fear of missing out, where people are just throwing money into the market because they're afraid of being left behind. And that carried out after the election. And then it carried through last weekend as people make their decisions over the weekend. And then they executed those on Monday. And then there's really no figures about this. It's more of a feeling of what you're seeing in the market. But once that kind of got dealt with, the market just slowed down and it looked exhausted and it really lacked a lot of conviction until later in the week when we saw things turning more negative. And if you watch the daily videos, we saw those things coming stronger and stronger with some of the indicators that we look at. That's why I really recommend watching the daily videos. I know they're longer. I know I show a lot of charts. That's all by design, because to really understand what's going on and to use the tool of technical analysis, you see these small little changes that take place. Sometimes they turn into nothing. Other times they develop into something. But just knowing they are there, that's the big thing, so that you're not caught off guard. You can see, okay, this is just a little concern right here. I want to keep an eye on that. And maybe that'll be proven wrong, but maybe it'll be proven right. And we saw some of those things coming together later in the week that turned things back more negative. Now, at this point, it just looks like we're pulling back. The 20 period moving average on the daily charts are still holding. And so that's more normal. That's to be expected. That's just people taking some profits after having a nice run up after the election. What we'll be watching for now is, are some areas of weakness going to turn into even more weakness and lead to ultimately price declining further? Or are we going to be able to hold around where we're at right now and be able to bounce up from that? Now, everybody can have an opinion about what is going to happen. I don't do that. I don't do forecasts. I don't try to say, well, this is going to happen, that's going to happen. We look at the charts and we just say, okay, this is where things are at right now. And so this is what we're watching for going forward. There's a case that could be made that we could come bouncing up out of this and go back to the upside. There's also a case that could be made that we could break further to the downside. And that's what I do in the daily videos, is just go through all of those things just to get you armed with what I'm seeing and what I've found works over decades of doing this. So now you can sit back and say, okay, these are the things that I'm keeping an eye on. And then that helps you make decisions about what you want to do. And you're also going to have to pardon my voice. I'm dealing with a head cold right now. I feel okay. I just don't sound all that good. And the Kleenexes have not been very far from my hand for the last few days. So even though I tend to clear my throat and cough and things, it might be a little even more severe than usual this time as I try to battle through recording this video. Okay, just know, as I've already talked about with the daily videos, that, and you don't necessarily have to watch them every day. Now, there's another video that I do that's only available on the website, and it's usually maybe 15 to 20 minutes long, where I just break down the main charts that I look at. One of the criticisms of what I do is like, your videos are so long, you throw so much information out there. Yeah, and that's what I found works. I don't believe in this idea of analysis paralysis. I believe in what I call the consensus approach. And there's other folks that call this the weight of the evidence approach. As good as technical analysis can be as a tool, nothing is perfect. And there are some indicators that give really good signals at just the right time. And so you start to depend on those, and then they break down and they give you a bad signal at just the wrong time. And so I like to take everything together and then reach a consensus saying, okay, the weight of the evidence is that we're looking positive or we're looking negative. Right now, we are positive, but we're vulnerable at the same time. And how I go through that is in the daily videos. All right, then I do have a PDF because I'm not trying to convince anybody of anything. What I'm trying to do is I'm an educator and I'm trying to teach people about this skill. I'm not trying to just have a bunch of followers who just blindly follow what I say. And I get criticized for that because people want that. They want to be told what to do. No, I'm an educator. I teach people how they can do it for themselves. And one of the tools that I have is I make a PDF available below every video that I post. So you can look at the slides that you're seeing right now where I have text and you can look at the charts. And if you're a member of stockcharts.com, I have all my chart. I look at 300 plus charts every day. If you're a member, I can actually share that list out with you. And so you don't have to recreate all the charts that I'm using because the goal is to get you to the point where, okay, I see where he's coming from. Understand the logic behind this particular indicator. Now I'm going to take that and turn it into my own form of analysis. That's what an educator does. I'm not trying to just, I call it creating a religion where people just say, oh, John's saying this, John's saying that, we must follow him. No, that's not my approach. All right. So a PDF might be a useful tool for that. Also, another useful tool are a thing called pivot points. These are pre-calculated. And the cool thing about that is they're calculated for the whole month, and we know what they are before they're even out there. And you'd be surprised of how accurate these things can be. There's also pivot points that I put up on the YouTube community tab that are just for that particular day. So I update these charts every day, and especially the intraday charts. I follow a 10-minute intraday chart, and it's just surprising day after day after day. We start going up, we hit one of these resistance levels, and we stop right there. We're going down, we hit one of these support levels, and we stop right there, or at least slow down. The algorithms out there that account for anywhere from 60 to 90% of the volume on the exchanges, they've got all this stuff programmed into them. And so these computers out there are watching for these same things. And that's why you see things happening around these different levels. All right. I do have a private Facebook group, not really active, not a lot of members, but you can change that if you want to. I have a program, but you may not be interested in that program, but you still want to have a tool where you can have more direct communication with me. Join the Facebook group if you're a member of Facebook and ask me questions or make a comment. The only thing I'm really posting there now is when I upload a video. And so it's not a really active group, but if you don't like that, then change it. Then let's make it more active. If that's something that you would like to do. I do really go through and watch YouTube and Rumble comments. They must be taking a break or something at Fiverr because I've seen a slowdown in the scam comments, the people that are social media experts and they're really just trying to sell you something that you don't need. And then it's amazing how they ask for an initial amount of money and then, oh, now it turns into a bigger amount of money and they're supposed to have all these answers. Yeah, I used to teach security for Microsoft, so I kind of have fun with these things every once in a while. But legitimate comments, unless you're rude, unless you're just being just totally unreasonable, you can, even if you disagree with some kind of a conclusion. And I'm not necessarily looking for a pat on the back either. I know what I do works and I know what I do is good, but that's not out of a sense of pride. That's out of almost 4 decades of success of seeing this work day after day after day. But if you have a comment and you want to post that, I don't get a lot of comments on my videos because I'm not making a stand. I'm letting the charts speak for themselves. And if you get a little boring seeing so many, bored seeing so many charts, okay, well, that's kind of on you. I'm just trying to present all the evidence here. And then at the end, we say, okay, things are looking positive or they're not looking very positive, or we're actually looking negative right now. So feel free. But if it's a crap comment, if it's a scam comment, if it's, one of these, some person, thanks to Mary Smith, I'm now making billions of dollars every month in cryptocurrency. I get rid of that stuff right away. And I do post on YouTube and Rumble. And sometimes I might have some uploading problems from one platform to the other. Here's the link to the Rumble channel. And then here's the program I'm talking about. And feel free to check that out. It's free until the end of 2024. It's going to be $97 a month, but I'm also going to be launching a daily newsletter. There's a way that you can only watch, that you have access immediately to the videos right after they're recorded, but you don't necessarily have to belong to the whole program. There are courses that I teach. So there's a lot of different things that are available to you as alternatives. And while it's out there right now, check it out. Now, if you're focusing more on the free parts, you're probably not going to be interested in the program. I'm trying to present good, solid information and trying to teach it the best way I know how to get you to a point of success. But if you're like, well, it's free, I know those people aren't really all that interested anyway. But you may come, check it out, and decide it's not for you. Or you might think, okay, this is great. I really like this. Only you can decide that. There's a link that'll take you to the website. There's another link that'll take you to a video. Here's an email address where you can set up a time. You can ask me questions. We could talk maybe on Zoom or Skype or something like that. And you get immediate access to the videos as they are prepared. And the daily video, as I explain in every video, that's the real foundation. All of the videos that I do every week, they're just meant to tie into the daily video. Now, you might be a longer term investor, but I deal with long term in the daily videos and I deal with it in the program. And so you may just be able to watch those kind of as you have more time. You maybe the newsletter that I'll be launching at the beginning of 2025. Maybe that's more to your liking. It'll be a lot pared down. You can read it instead of having to watch a video. But the real foundation is the daily video, where everything else around the outside is meant to tie into the daily video. All right, let's go back and talk about this week's session here. We were down 2.8%. So that's pretty big compared to where we had been going previously. We were above average with volume. Now, a lot of that volume came on Friday because it was the monthly options expiration. One of the things that's been kind of encouraging is uh, for the last week or so, except for the Friday, the 15th of November, we've been chopping sideways and having a few down days and seeing a real exhaustion in the market, and volume's been dropping off. And that's actually positive. It's if we were going down and volume's really picking up, that's when we start to get concerned. That means there's more conviction behind what's going on. And when we do go up, we saw it on an increase in volume. And so that's rather encouraging as well. We are still positive in the long term. Now we're taking a hit on some of our charts, and I'll show you that. And on our daily charts, we're taking a bit of a hit, but things are still holding together for the most part. Now that could change in the upcoming week. Something could come flying out of left field. The market really reacts to. There's been some doubt going through the markets now that maybe the Fed's not going to automatically cut rates at their next meeting. Some of the economic reports have been stronger than expected. There's some instability, of course, that could happen between now and January 20th about the election that hasn't really materialized yet. There's geopolitical things going on between Russia, Ukraine, between Iran and Israel, and other things that could develop at any time. So this is all out there. All right. Then, as far as our trend, and this is what it's been for quite a while here on the weekly chart. It's a weakening trend since we're below the moving average. That means the trend is, we're still trending, but it's getting weaker. but it's positive. The green line is above the red line, and I'll show you the chart of that one. All right, so here are just some bullet points for the week. The most positive day was Monday. Well, that was Veterans Day, and the bond market was closed, but we might have seen some FOMO, fear of missing out, over the weekend as people were making their decisions. They hop on their computers, place their orders, and we had a pretty solid open on that day. And it reached a record high, and we actually got above 6,000 for the first time. But as the week played itself out, we declined over 2%. Mega caps and semiconductors underperformed. They're getting hit right now. These are the real leaders of the market, and they didn't lead as much this week. They're not falling apart, but they are seeing some profit taking right now. And then healthcare. A lot of this came on Friday because there's some real changes going on with the new administration going in. And Trump he says, I'm going to nominate RFK Jr. to lead the Department of Health and Human Services. And that freaked out the healthcare sector. Not because they don't necessarily agree or disagree with what the plan is to be done there, but it's different. And so now they're having to shift to new realities, and there's a whole paradigm shift for how things had been going. And there's talk that things are going to be massively different. And so when the market is faced with uncertainty, sell. And that's kind of what happened. And with a lot of that coming on in Friday's session, interest rates are still going up, and this is pressuring stocks. We also have the dollar going up as well. This is pressuring stocks also. Now you could see the dollar going up as being somewhat positive. It's like, okay, well, U.S. currency is pretty solid right now against the euro, against the British pound, against the yen. So that could be taken as positive, but it's better for the stock market if the dollar is weaker because of the conversion rates, and the import-export relationships are more favorable with the dollar being weaker. But interest rates are getting to be a concern, and they've been going up ever since the Fed started cutting rates. It's like, okay, figure that one out. So we're up at 4.43% with the 10-year yield, where a week ago we were at 4.31%. And we were concerned that we were at 4.31%. We actually got up to the 4.5% on Friday, but then we were able to back down off of that. And then Chair Powell came out this week and said something that the market really didn't like. He said the economy is not sending any signals that we need to be in a hurry to lower rates. That's not what the market wanted to hear. They wanted to hear what they interpret him to say before, that, yeah, okay, we're going to come in, we're going to cut rates. They cut it by 0.5% the first time, and then 25 basis points the second time. They were pretty much figuring there's going to be another 25 basis point cut the third time. That's a little bit in doubt right now. Okay, so and these numbers are going to be a little bit different. Is it Friday to Friday? Is it Monday through Friday? So there's a little bit different calculation here with the change. But the Dow was down 1.2%. We were down over 3% with the NASDAQ. We were down actually over 2% with the S&P, but they have it down 1.7% here. And then the small caps, which, of course, now's the time for small caps. They're wonderful. They're amazing. They shot up and did really well right after the election and gave back 4% of those. They're still up, but they gave back over 4% in this last week. This is what we're keeping an eye on too, because we're seeing these economic reports coming out stronger than expected, which could be inflationary. And of course, everyone has an opinion, but we look at the charts here. We just want to keep an eye on this. We went through a period in the mid 70s or so where inflation was really coming down and under control. And I've been showing this chart for well over a year and a half now, and we're still in this downward move with the light blue line. But look at what happened after that. And there are concerns, which are legitimate because things change. If we do get into a period of real economic growth, that usually brings inflation along with it. And are we going to hit some kind of hyperinflation? Is this massive amount of spending that the government is doing, is there going to be a reckoning for that? So we'll have to just see. Now, it could deviate from this and actually work out in a different way. I show this chart just so that people have a tendency to think the way things are right now is the way they're always going to be. That's not true. Things do change, and we have to at least keep that in the back of our mind. And then RenMac came out with this research. This is also a chart that I've showed for at least a year and a half now. And according to their research, I know we've got the graphic here that might be a little hard to read, but when they get above four, when the 10-year yield gets above 4.02%, that's when companies start to feel the impact of higher interest rates. And we're at 4.43%. So we're well above that level, and that could put some pressure on future earnings. And this was updated right after the employment situation report came out and won't be updated again until the report comes out in December. But we are seeing an increase in those folks that are unemployed for longer periods in time, over 6 months now. And this is a chart that I show every week. I update it with the latest chart that I have available. The takeaway from this is the red line, the red arrow going up here, and it's going up and to the right. And that just means that earnings are looking forward as far as estimates. And this justifies stock prices going up because it's ultimately earnings that drive stocks. And then this is in the daily video for Monday, I showed how the S&P behaves around an election time compared with who was actually president at that time. This is kind of a companion chart where we look at the 10-year yield around a presidential election, and they really haven't been able to conclude anything here. It says no consistent patterns around prior elections. So you can't really read much into that. And U.S. equity market dominance. The U.S. market is still the strongest of all when you compare it against global stocks. And I have other charts to go through and show that. And then gold, which had been just on a tear lately, it's been seeing some problems. It's been seeing some profit taking. No, I don't know if this climate has necessarily changed, but this hitting all-time highs day after day after day, that's not happening right now. And I'll have a gold chart to show you here. We did get retail sales in Friday's session, and we see this chart after retail sales come out. And now this is a little bit of a concern because you see back when we had the recession in 2001 into 2002, retail sales were going up and then they leveled off, boom, recession. And then we had the great financial crisis. Retail sales leveled off, boom, we went into a recession. Well, then, of course, COVID, which is its own little thing. We've been leveling off, though, but retail sales have been hanging in there fairly well. They've actually been going up a little bit lately, but we leveled off, but we have not, to this point, at least gone into a recession. And yeah, there's folks that think we're going to hit one. There's other charts that we look at that suggest, no, we won't. We just have to look at the evidence as it's presented to us and then make our decisions based on that. All right, the mention of AI on earnings calls. Now, the website that I go to is called factset.com. This is put out by Goldman Sachs. And this just talks about AI is still the real buzzword right now. It's coming down a little bit, but this is where things are really at. And they talk about AI when the companies they have these conference calls after their earnings are released. Here's FactSet itself. And the takeaway from this is that companies that have international exposure, which are most of the S&P 500 companies, they're U.S. companies and they have to be based in the U.S. That's one of the criteria of the S&P. But they can do business wherever they do business in the world. And they're seeing growth above 10%. So that's more or less healthy. And you can see the green, kind of the sickly looking green here, looking on the third quarter, and then also another way they measure this, and then the light blue area versus international companies and so forth. So this just is just trying to show that international or companies that do business internationally are still doing pretty good and seeing good earnings from that. All right, here's the intraday chart. The most positive day was actually Monday, and it really wasn't all that great. This is when we got above the 6,000 level, but you can see not an awful lot of conviction here. It was a little bit encouraging on Tuesday when we drifted lower, and then we were able to bounce up out of that. So we actually saw some buying coming in. And then Wednesday, it was looking a little bit better. We had a lower open with some buying coming in. But then everything started to shift in Thursday's session. And Wednesday is when CPI came out, and there really wasn't much of a reaction to it. PPI came in pretty much as expected too, but there's some inflationary components that the market decided to freak out about. So this is where we started to see some weakness build in Thursday's session. And then we had retail sales, which are still pretty solid, but the futures were already negative before the market even opened. And that's when we saw the gap lower, and then we saw most of the damage done in Friday's session. So for the week, all the indexes that I follow here were down. This is just the 5 trading days, Monday through Friday, with small caps leading the way lower. Year to date, though, all of the indexes are still positive, including small caps and the sectors. And then I sort this a little different way when we have a down week. Healthcare got hit the most, with most of that coming on Friday. The tech sector, that's a growth area, that got hit. Communication, another growth area, got hit. And then we see utilities, energy, and the financial sector is doing quite well. And that's rather encouraging that the financial sector is holding together and just coming off of all-time highs. So we're at least based on things right now, we're not seeing some kind of great financial crisis in the future, but that could always change. That's why we watch this sector. And then if you look at this based on a Scooter score, we have three sectors that are in the 90s: financials, discretionary, communication, and discretionary and communication. Those are growth areas. And a lot of the discretionaries, Tesla's been doing good, Amazon's been doing good. Communication is another area that is quite positive. Where healthcare, look at he's getting a score of 7 right now, and that's more defensive. But this is encouraging longer term, even though they took a bit of a hit this week, and they may still take more of a hit. These discretionary and communication doing well, that's encouraging. And we'd like tech to do better, but it got taken out and shot a little bit this past week. So here are the sectors for the week, just showing which ones are positive and negative, with healthcare leading the way lower. And then going back to the beginning of the year, healthcare, which had been looking better, is now weaker year to date, with financials and communication being positive, barely positive with utilities. We'd like tech to turn back, discretionary to turn back positive. Those would be more growth areas. And then here's the relative rotation graph where we can see XLY. That's discretionary. This is coming on and looking a little better, where it's been a disappointment for most of 2024. We have industrials, that's more driven by the economy, the financials, which are looking pretty good, and communication, which is coming on a little bit better. But this is a weekly chart or weekly calculation going over the last year, where we were seeing real estate really doing a lot better, and we were seeing utilities doing better. Real estate, like that interest rates are going down, but they've been going back up. And so that's been pressuring this area. And then utilities, which were coming on strong, they're seeing a little bit of weakness lately. And we have staples, which is more defensive, healthcare, more defensive. And we're seeing a little bit of an improvement here with energy. It ended up having a pretty good week this last week. And this is more of a spreadsheet look at communication, industrials, financial, and discretionary looking more positive. Seeing some weakness in real estate and utilities, actually turning negative here with staples and healthcare. And these are two defensive areas, which actually could be more positive for the market. Of course, it's not positive if you own any of the stocks in these areas. And then more neutral right now, but showing an improvement with tech, materials, and energy. Then we look at just the major indexes themselves, where utilities had been a stronger area, and you can see the yellow. That means it's showing weakness in a really long tail. That means that it's this decline has been going on for longer. We're seeing some improvement here over here with transportation, the mid caps, and the Nasdaq 100, especially the Nasdaq 100. We want that to do better. Small caps just can't figure out what to do. And then we have the S&P as well as the S&P 100 here, which have been showing some improvement, but not really looking all that strong right now. Here's the spreadsheet with the S&P 100 and the utilities, seeing some weakness in those areas, seeing more weakness here with the Dow Jones Composite, the S&P, and the small caps, more positive with the Nasdaq 100, mid caps, and the transportation index. All right, sentiment. Every week we get something called the Investors Intelligence Survey, and a lot of people watch this, but right now it's not really telling us much. It's coming in at 2.91. It's below 3. When we really pay attention to this is when it gets above 3 or below 1. That means it's getting extreme. And then here's another sentiment indicator. Now it's probably come down a little bit since this chart was generated, but folks were getting a little too optimistic and just starting to take the market for granted here, coming in with a very high reading. And this is also shown here by the euphoria meter. It takes the forward-looking PE ratio, the VIX, and then bullish sentiment from I believe it's the American Association of Individual Investors, and puts them together. And we're getting a very high reading right now. And that could just suggest that the folks are too optimistic. And here is the chart that I look at every day, coming in at 51 right now, which is neutral. We had been positive. We were getting concerned as we were going up that we might hit this 75 level. We didn't. We didn't really get up that high, but now we've been seeing some weakness and we're dropping back down. And this gives us a context where we were going up. That's positive, and we tend to go with this when this is going up. But now that it's going back down, we're actually looking at this being more negative for the time being. And the active asset managers getting above this red line, getting a little extreme. Now, this is a week old. So this came out after the election, at least most of it did. And when these guys get a little too optimistic about things, now we could still go higher than where we're at, but they're human beings just like everybody else. And they have peer pressure and they have client pressure and they have performance standards that they have to live up to. And so when they get a little too optimistic about things, that could be used as a contrarian indicator. Here's also looking at that same chart coming in at 91.6. We're above the 90 level, and that's when we get a little bit concerned, seeing that it can't even go higher than where we're at now. The VIX, after really being high before the election, dropped off, but it did go back up with the declining week right here, both with the line chart and the bar chart. And usually what we see during this time of year is a decrease in the VIX, which means stocks are going up. There's a period of positive seasonality, and I have all the positive seasonality charts to show you near the end of the video. This is also something that I look at more as a sentiment gauge. This compares cash with the tech sector. When this is going down, that means the tech sector is outperforming, and that's what we're seeing right now. And the RIDEX bear bull ratio. Are folks getting into the bullish funds that increase in value as the market goes up, or the bearish funds that are mutual funds that increase in value as the market goes down? They're pretty bullish right now. The Ulcer Index still below the moving average. We're actually a little bit above the moving average on the daily chart. Not seeing any real concerns here. This is the spread between risky and not as risky bonds. And then I break it out here and do an inverted version of this. As this goes up and up and up, that just means there's less risk in the market as perceived by the bond market. We do get every week the American Association of Individual Investors. They came in a little bit above this green line. And this is a week ago when things were still very happy about the election, but not necessarily really extreme. We get real concerned if they go above 30. Now they're above 20 right now, coming in at 21.5. And seeing a little bit of a downward move here when we look at the VIX versus a 3-month average of the VIX. And that's just because the VIX had been coming down after really going up. And then we look at a long-term view of the equity put call ratio. When this is declining, that tends to be more positive for stocks. And we're still below the black line here with the financial conditions index, so this is not really generating any warning signs. The latest reading of GDP, called GDP Now, coming in at about 2.5%. And then the forecasts are anywhere from about 2.5% to the upside to about 1.5% to the downside. And this is what we want to keep an eye on too. If we're going to go into a recession, that's going to mean that GDP is going to need to turn negative, and it's not turning negative, at least yet. And then this wasn't updated since the economic or the employment situation report came out, where we're coming in at 0.43. The red line is at 0.5, and that's when we get concerned. It actually went above that, but now it's starting to come back down. Also, not a real concern here with the smooth U.S. recession probabilities, and the Brave Butters Kelly leading index is still declining, but this is only updated quarterly. Inflation, we did have CPI and PPI come out this past week. CPI is measured here on the chart, so there were some adjustments to that. And then the Fed, what are they going to do at their next meeting on December 18th? 61% chance that they're going to cut rates another 25 basis points. 38% chance that they're going to keep rates where they're at right now. And this shows how that changes over time, where they were a lot more convinced a month ago that they were going to cut rates than they are right now. And we're seeing a little bit more of a pickup here, and that maybe they're not going to cut rates after all. And then we look out to the meeting after that, which will be January 29th, kind of seeing a whole mishmash here. We don't really put a lot of importance in this until the meeting itself actually gets closer. And this just shows you how this changes over a period of time. Fed balance sheet still continues to go down over here, even though it's going up with the number. And then we look at it, the year over year here, where it's going down here, but it's actually going up here. Only government charts can do that. And then the overnight reverse repurchase agreements. We watch this to see if anything weird is happening in the financial sector, specifically with banks, and nothing all that out of the ordinary seems to be presenting itself. So most of the time we just look at this chart. We just see if anything's happening that looks strange. All right, getting into our analysis here, the advanced decline line did take a bit of a hit, but you notice down here based on volume, it didn't really take much of a hit. It actually declined a little bit more based on price. We're still above advancing moving averages. So this is still longer term positive. And we saw a little bit of an expansion of the new lows, a little bit of a contraction of the new highs. We're going down with the 4-week, but we're still going up with the 10-week moving average. This is another internal measure that we look at that for the time being is, yeah, it's showing some weakness, but it's still hanging in there. And then the smart money indicator, we're still above the red line and the red line's going up. That's positive. Now we've actually turned negative on the daily charts. We've dropped below the red line recently. And we look at the advanced decline ratio, it is declining, but we're above zero, so it's positive. And this is the condition of our trend where we're starting to turn up a little bit, but we're still below the moving average. We're getting close to that 20 level. Now, there's some dynamic aspects of this chart and static aspects of this chart. One of the static aspects is that I put a line at 20. We don't change that number. The dynamic aspect is I plot a moving average on the ADX itself, which is the actual indicator. And that's dynamic because it changes every day and it may mean something at one level and mean something different at another level. It's trying to turn back up, but we're still below the moving average. We're in a weakening trend as long as we're still going down and below the moving average here. But we're positive because the green line is above the red line, but we're seeing the green line coming down. However, we're also seeing the red line declining as well. We would like to see this cross back above the moving average. That would suggest a strengthening trend. And if we're more positive on the market, we want the green line above the red line. And then the Arun indicator tries to measure the difference between buyers, that's green, and sellers, that's red. Still looking positive here. We're also positive on the daily chart. And the oscillator down below measures the difference between buyers and sellers. Mass index not generating a signal right now, so I won't cover that. Here's a daily chart that actually this is out of date. Okay, this is actually a week old. And I don't want to go back and restart this. Let me pause this and get the correct chart up here. Okay, hopefully that wasn't too awkward as I paused the I used to use other software. I could pause and I edit. Now I just do everything is take one. And that's why you get my slips of the tongue and clearing my throat because when I edit the videos, it takes many hours to do that. And I would rather go do other things, to be quite honest. The reason I really wanted to show this, and I have to bring up the pointer again here, is that we actually came down below this dashed line here, which is a pivot point, and that had been a support level that was actually holding up. And the fact that we came down to that, yeah, that's negative, but we're still above this other pivot level, and it's not on this chart, but we're still above the 20 period moving average. So for right now, these levels are holding. That's what we're going to be watching in the upcoming week. Are we going to fall down below this dashed line? Are we going to fall below the 20-day moving average? That would turn the short-term trend from positive to negative. And then this Keller market model, we're actually switching over negative in the short term with the NASDAQ 100. And this looks across the market where we're negative with bonds based on price in the short and intermediate term, negative with commodities on all time frames, and negative in the long term still with the dollar. and still positive with the decision point scorecard, but don't put a lot into this. They can sometimes be very late at updating this chart, but for right now, it's still positive. Oh, now we have this other chart. Isn't that nice? Okay, then we have the trend channel here. Now, something longer term that we may be running into is this is a trend channel going back to 2009, and we're actually bumping into the top of this, and that's just about where we topped out. But we've broken through that before. But if you've been in the markets for a while, this was into 2021, into late 2021, where the market was just skyrocketing up and up and up and up and up. And then we went into 2022 after that, which was a bear market. So we actually broke above this level. Okay. But other times when we've come up to this trend channel, that has provided some overhead resistance. And so we want to see, is that going to mean something now? And then we have pivot points here, but we did come down over 2% here. But if you go all the way back, actually to about October of 2023, this is still a pretty healthy looking chart. Even though we fell this week here, each one of these bars is a week. And so this is still looking okay. And even the pullbacks that we've seen haven't done a lot of damage, at least to this point. And here is a look at the longer term trend, just as measured by the 50-week moving average, and then the S&P weekly chart here. Still looking really solid there. And then I do a moving average crossover study here with a 13-week moving average and a 50-week moving average, which kind of equate to roughly a 50-day and a 200-day moving average. We're coming down, but we're still above the blue line. The blue line is above the red line, and everything is still going up. And then we have the McClellan oscillator, which is dropped below the midpoint here. So it's turning a little bit more negative. And the summation index based on price is declining, but still above zero. We're also declining, but still above zero based on volume. The bullish percent index, the context right now on the daily chart is that we're going down, even though we're above 50. So we're not officially negative, but the context is that we're declining at this time. So we're treating it more as negative. And we're dropping below the midpoint with the Swenlin trading oscillator based on price and volume. We've gone negative on the daily chart too. Momentum is just kind of chopping around right now with the PMO still kind of right on its moving average, coming back up a little bit based on price, still above zero here based on volume. And then there's some studies that are attached to the PMO. The PMOs that are rising that are inside of the S&P 500, they are declining but not falling apart. We're flat with the buy signals that are being generated, and we're declining to flat here with the PMOs that are above zero. And a week ago, we did close outside of the upper Bollinger Band, and we saw that on the daily chart, and that's very rare to see that, where the daily chart and the weekly chart are generating a signal at the same time. Well, we came back down now. You can see we got extreme here. It's no longer extreme for right now. And this is causing a concern on the daily chart. We're actually negative and chopping sideways, where we're more chopping sideways, but a little more positive here. We're a little bit concerned because the red line, which is a moving average, is going down slightly. But longer term, the fact that this is green is still positive. And here's another look at momentum. We have two short-term oscillators, the slope and the TSI. The slope is actually looking a little bit better where the TSI is flat. Then we have intermediate term. I have three of those, the MACD, the PMO, and the PPO. Not really moving all that much. The MACD is actually looking a little more positive. And we have some long-term oscillators, the TRIX and KST. They're just kind of flat right now too. And the force index is actually turned negative on the daily chart. It's coming down here, but still positive on the weekly chart. And we're negative with the Chaikin oscillator on the daily chart, where we're just seeing a pullback here on the weekly chart. And we're still positive with the money flow on the daily chart and still positive here. The rate of change going back 1 week, that's from week to week. And we had a down week, so that's why you see a decline here. Coming down, but still above this red line when we go back 50 weeks. The Stochh RSI, and we don't have anything other than a longer-term stochastic chart that's extreme right now on the daily charts. The whole short-term list has now been knocked off. Nothing is extreme positive, but we're coming down a little bit here with the Stochh RSI. But the RSI, it's declining, but still above 50. We're turning a little bit more negative in the short term, still looking okay in the intermediate term on the daily charts. This is something that we waited a long, at least I have, waited a long time to see. We're finally crossing positive with the special K. It had been positive for a long time, and you can see these changes, these crossovers don't happen very often. We've been positive on the daily chart for quite a while, but we've been negative going back to the earlier part of 2023. We've been below the red line. Now we're finally starting to cross back above it. So this is much longer term positive. Williams percent are coming down, not quite extreme here. The ultimate oscillator, it has dropped below 50 on the daily chart. It's just declining here on the weekly chart. And we're actually still going up with the vortex, where we're seeing a little bit of vulnerability on the daily chart with the green line going down and the red line going up, but the green line's still on top. Here, it's continuing to go up, and that's still quite positive. Maybe a little too positive since it's going above this line here. The copy curve, another momentum oscillator, continues to be positive here, where we're still hanging in there. Actually, we're more negative, I think, on the daily chart. And then these are longer term support levels. Even with the decline, we haven't come down to any of these points right now. So looking at the condition of our trend, where we're seeing more of a mixed to negative picture on the daily charts, we're still positive here on the weekly charts. We're positive with the black line pointing up on the Kagi chart. The Renko is actually looking more negative on the daily side. It's positive here on the weekly side. And we saw a real move up here with the ease of movement going back 14 weeks. So that's still positive there. The three-line break showing a little bit of negativity on the daily chart, still looking positive here on the weekly chart. And no new X's or O's were drawn with the point and figure chart. We didn't have enough of a move for any of those to be generated. The momentum long term just kind of flattening out here. We're after declining, starting to flatten out in the intermediate term, actually seeing a little bit of a pullback here in the short term. And then I don't know whether to include this or not. I don't know, year, two, three. I'm always testing cycles, and then about the time you think you find one that works, it stops working. Well, this is a 50-day cycle, and right around Halloween, maybe give or take a few days, that's when we started a new 50-day cycle, and that's when we've been bouncing back up since then. I don't make decisions. I know there are people that have these magical cycle charts that they think are the ultimate answer. I don't think that. I just think they're kind of interesting, and I like to look at them, but I don't make decisions using them. And then we've gone from being positive to neutral with the Elder's Impulse system. We're still positive with the parabolic SCR. We're still positive on the daily charts too, but any more weakness and that could change on the daily chart. And looking at the different indexes, just coming off of an all-time high with the S&P, the mid caps, and even the small caps, but seeing a pullback pretty much across the board here. The Dow is still looking pretty solid on the weekly chart. NASDAQ also still looking okay, even though it had a down week. The NASDAQ 100 pulled back, but still looking positive. Here's another look with a red candle here for the week for the QQQs. The mid caps pulling back after setting an all-time high. Small caps pulling back after setting an all-time high. NYSE it's a broken record, pulling back after setting an all-time high. The big software companies not an all-time high, but they've been really showing some strength, but we're down in this past week. All stocks coming back down, but still above the moving average. The FANG index setting an all-time high and had set an intraday high this past week, but ended up being down on the week as well. ARC, which was seeing a little bit of hope, ended up being down over 1% on the week and still in a longer term downtrend. No, actually, we're seeing a golden cross here. The blue line's crossing above the red line. I look at the number over here. The Wilshire, another broad market measure, was down 1.33% after, and this is a daily chart here, after setting recent all-time highs. The bank index is still looking good here. In fact, we're getting a little extreme with the RSI, but the momentum is also still positive. This is traditional Dow theory, where we're coming off of an all-time high with the Dow. We finally broke out here with the transports, only to give some of that back this week. Utilities had been strong, had been strong, but have been under some recent weakness. Seasonality, November tends to be positive. If you take from 2020 till now, it's up 80% of the time with a return of 5.4%, according to this chart. And commodities just kind of chopping around right now. When they're really going up, that tends to be more inflationary. When they're going down, that's more deflationary. Oil, mainly watching that for geopolitical reasons, and it's not really moving all that much. Copper, another barometer of the economy. We're still in an uptrend here, even though it was down over 5% on the week. The dollar just been ripping. So if you want to do some traveling, going to England, going to Europe, even going to Japan, you get a pretty favorable exchange rate right now. And gold, after setting an all-time high, has been pulling back here. And silver also pulling back recently, but still in an uptrend there. The total bond ETF still in an uptrend, but has been seeing some weakness as interest rates have been going back up. That means price is going down. Stock to bond ratio still shows stocks outperforming bonds here on a monthly chart. This is a daily chart, how we were really coming down nicely with the yields, and then the Fed comes in, cuts rates, boom, we're going back up now. Kind of the opposite of what you logically think would happen. A weekly chart looking internationally with the US and UK rates being the highest, and German rates in blue, and Japanese rates are going up a bit here. Those are in red, the land of the rising sun. And the intermarket analysis chart here. Gold had been doing the best. Even though stocks were down this week, they're now performing the best year to date. Gold has really taken a hit lately. And then green, that's the dollar. Red is oil. And bonds based on price are still negative year to date. We do a ratio between the NASDAQ 100 and the S&P, both coming off of recent all-time highs. But this is in a downtrend showing that the S&P's actually lately been outperforming the NASDAQ 100. The S&P 100 continues to outperform the S&P 500, and those are the bigger stocks outperforming the smaller stocks. Growth of value, that when this is going up, that's what we want to see. That's more positive for the market, and we're still seeing that here. Gold really dropped off when compared to the S&P itself, and gold also dropped off when compared to the dollar because we're seeing some profit taking in gold and strength in the dollar. And then we look at a ratio between bonds and stocks. When this is going down, that means bonds are underperforming. Low volatility stocks, which tend to do better in a more defensive environment, still underperforming the S&P. Discretionary doing a lot better, seeing a golden cross again here with this longer term ratio. And that's more positive for the market to see discretionary outperforming staples. Energy had a good week coming back up, but still in a longer term downtrend when we look at it with a ratio of tech. And then we look at small caps to tech, showing that small caps are still continuing to underperform the tech sector. Longer term look here, this is the NYSE breadth thrust. We're still working off of the signal that was generated in October 2022. This is the ZWAG NYSE breadth thrust. No new signals being generated here. A long-term chart going back to the 1987 crash, still looking good that way. This is a further blow up going back to 2018. So we're still well above this long-term trend line. NASDAQ 100 also still above this long-term trend line going back to 2009. And I wanted to point this out. This is a Horchak method. For most of 2024 and a lot of 2023, this was on a full-on buy signal, which is 10. And then right before the election, it dropped down to 8. And then after the election, it went back up to 10. Now it's dropping back down to 8. Not negative, not changing from negative or positive to negative, but just something we want to keep an eye on here. If this really starts to drop off, these are very long-term buy or sell signals. As long as we're still above zero, we're on a buy signal. If we drop below zero, that turns into a sell signal. But we want to know the context. Is it going down or is it going up? And then looking at the new highs, new lows on the NYSE, still above zero, still looking positive there. With new highs, new lows for the S&P 500, also still well above zero here. The ratio between the NASDAQ 100 and the Dow still holding up with that ratio. And the NASDAQ 100 to small caps falling a little bit below this blue line, but not falling apart the way the perma bears think it will. And we're coming down a bit here with the 3-month yield. We're just watching that because that's what happened before the great financial crisis. And that's why we watch the financial sector and bank ETFs and things like that to see if anything is looking amiss there. And so far, no, it's really not. And then the cumulative new highs, new lows for the NASDAQ overall has been going back up. That's more positive there. Then I have a whole list of different types of ways of looking at seasonality. November is up 1.5%. That's the average return 68% of the time. Then November through April tends to be the strongest time of the year, up to over 7%, 77% of the time. And then I don't really like these charts. The median here from 1976 to 2023, the market actually has a chance of performing better after the election when it's not a presidential election year, but they still tend to perform fairly well here. And then this is from 1984 to 2023, and taking an indexed look at all the, just you can see the positive seasonality there. This is a chart put out by Dan Bird, where we're coming more into November, where we also see um, positive seasonality since 1980 when it's an election year. And then this looks back to 1950 on a monthly basis, and November tends to be the strongest month. And then on a world basis, November is not the best month, but it still looks pretty positive. And then we have November and December showing positive seasonality going back to 1928 during the 4-year presidential cycle. November through January tends to be positive. So we're looking at this in a lot of different ways here. And then this is the whole quarter taken together, where it tends to be the most positive quarter going back to 1950. And we're coming out of the first half of November, which performs well, but the second half tends to perform even better. We'll have to see if the market's going to stick to these norms here or deviate from those. And then here's the Carson chart showing from November. You see, that's not straight up. There's down times in this here, but we do see positive seasonality during an election year overall. And then September, October were supposed to be terrible, and they really weren't that bad. So November so far has been pretty good. We'll see if that can carry over into December. And then looking at the November here, the last since 1950, going back to past 20 years, 10 years, and then during an election year, they all tend to be positive. And then November looks good here. Um, you can just see there's a lot of evidence for positive seasonality, but we can always deviate from that. These are not 100% of the time that they actually happen. And we're up 11 out of 18 times going back to 1950, down 7 out of 18 times with a return of 2%. Thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.